how do you know when a fair value gap is not going to work? A fair value gap that fails in its function of bullishness or bearishness, if it fails, it will become an inversion fair value gap after it comes back to it. So there's no reason for you to be upset about taking a trade and getting stopped out if you try to use it as an entry to go long and it stops you out. You're going to get mad and think everything doesn't work because of that, when it should be, wow, okay, I got that wrong. All I got to do is sit back and wait. When it comes back up and hits it, I'll treat it as a shorting opportunity. But when they fail, that gives you insight. That's what a inversion fair value gap is. Here, I'm anticipating price going through this very fair value gap here for the express purposes that it will hopefully provide a shorting opportunity that would accelerate further downside. And this becomes an inversion fair value gap if we trade down but not below this low before returning back to it, because that sell side's still there and it would return back to this fair value gap because it would treat this as an inversion fair value gap. There's only buy side here on this candle passing through it. We didn't get to it here. We went just shallow into it here. But from this candle's low to that candle's high, there's only buy side. It was delivered only here on buy side. So what is it missing? Sell side. So if it drops down, it offers that sell side to this candle's high. So it reprices to that range low, which is this candle's high. So that fair value gap has been repriced to offer the buy side that's been given here and then sell side. So if it moves away from it, comes back up, what is it going to act as? A balanced price range, which is the reason why I'm telling you that I would like to see it only trade to halfway. It can trade up to the highest point, but if it tells me, no, I'm not interested in going all the way up to the top of it after moving below it, if it hits the low and only stops at midpoint or just below it and then starts to move lower, that's exactly what I want, because it's signifying that the balanced price range is not permitting price to come all the way back up to the high of it. It need not do that. Why? Because we've already traded down to it a little bit in here. So we've already had sell side offered to that degree on that candle's low. If this candle didn't trade down into the upper portion of this fair value gap, if it didn't do that right there, then the one pass through it where I expect the fair value gap to fail here, not offer support, then I would treat the inversion fair value gap as it can go all the way to the high. Why? Because it wouldn't have had this drop down in the upper portion of this range. See that? But because it did that, it's already offered a measure of sell side. So between that candle's low, I don't want to see it trade above that blue line. If it trades down, worst case scenario, it can create a mohawk, which is a little tiny little deviation above or below a level that would be the level I'm looking for to be respected. But because markets are factoring a spread, and that difference between this candle's low and the high of the fair value gap, which is this limit here, so I'm going to highlight both levels. I don't want to see price, if it trades down below it, I don't want to see it trade back up in between these two levels once we get below this shaded area, because the effects of this candle trading down to the upper portion of this fair value gap, it's already offered on the basis of this move here. That candle right there, that day, has already delivered most of the upper portion of what would be this fair value gap. So because it has done that, I don't want to see if we trade below it and then it comes back up and touches the low or halfway point. I want it to be sensitive there and not trade any higher. But it can create a small little mohawk just above that line there, but not touch the upper portion. If it does that, that tells me it's exceedingly weak, and then therefore I would expect dollar to accelerate higher, and then any shorts that I see in NASDAQ should be high probability, and then this should sell off pretty aggressive, reaching down for the sell side below over in here. But if this candle hadn't done this very thing here, that means that the only thing that this fair value gap has seen, this portion right here, imagine that's not there. Say this candle had a low up here. That means that this range only had buy side offered to this point here. So what's it missing? It's inefficient in sell side because it's buy side imbalance. That means its direction was a closing candle higher. The difference between the candle before it and the candle after it is that there's a little gap in between where the market has to eventually reprice lower. We're not down there yet. So when you look at a fair value gap, you have to see how was it treated? How was it utilized? It wasn't even touched here. I said that wrong. It wasn't willing to trade down the consequent encouragement here. It didn't come to the very low of that candle here. It didn't respect that. It traded just inside the upper portion or upper half of that gap that's created by this candle's high and that candle's low. So because it's done that, I don't want to see it once it trades back down below it. I don't want to see it come back up and touch the top. But if this wasn't the case here, then I would expect and I would try to take a short higher up above the consequent encouragement of the fair value gap. And if I can get a mohawk right here on the high of it, or if it just pokes itself above it, I'll add a partial and pyramid in that very thing right there. And you've seen people ask, like, why were you adding to it? It was outside the fair value gap. that because a mohawk is expected. It's permissible. We allow for it. I'm not scared of it. I know it's likely to occur. If I can get fortunate enough, notice I didn't say lucky, if I was fortunate enough to get the fill on that mohawk that just punches just above that, that's superior entry. So now you have insights. When do I expect the fair value gap to fill? Why would I expect it to fail? Why would I like to see things remain open? I covered all that right here. Look real close. I'm not going to say anything. I want you to look at it. We have just crossed over something that might be impactful going forward. If you look at this candle's high, this candle's low. Now, let's play devil's advocate for a moment, okay? Say we gap down at the opening. We have a gap lower opening, and then we trade back up to here. I would like to see this trade just to the low, not trade to the top, be permissible to trade to the midpoint because this is a fair value gap. If we're bullish, this would be expected to offer what? Support and send price higher. But if we're bearish, what would we expect to see this do? Fail. This fair value gap fails, and it gives you insight. Now, if everything were to happen, so we have a gap lower opening, say we gap lower than this candle's low, okay? We gap lower than Friday's low. It can trade back up to this fair value gap's low, have a mohawk that could reach to consequent encroachment. I'd prefer it didn't do that. It can go to the low and maybe a tick or two above it and not trade to consequent encroachment and certainly not trade to the upper portion of it. Why? Why would I say that here? Because we have had this candle go completely through and below it. See how we ran through this gap here? This whole candle here went all the way to the high of the gap, which is this candle's low, to and through the low of the gap, which is this candle's high, and we create a little tiny little mohawk right there, colored outside the lines. That's completely permissible. That's acceptable. We are not afraid of that. Then this candle here, we trade down through it entirely. So now what did we do? Did we have any respect of this gap? Nope. Is that a bad thing? No. That means now if I get an extreme gap opening because it's the weekend, we don't know where we're going to open up on Sunday. If we open below this low, we're really technically oversold, and then they'll reprice against the opening price because everybody's going to want to do what? Chase it lower, think it broke out to the downside. So they'll enter right away because the market started opening up and it's trading. So now it's time to get out there and race and chase after investment profits. And it runs back up and touches the low of that fair value gap. I would like to see it do that and then roll over and go lower, aiming for this day's low. Why? Because it's a daily low. And then see if it can gravitate towards the sell side resting below here throughout the week. It may not happen this week, but gravitating towards this area down here eventually, but treating this as a premium array and expecting it not to need to trade to the higher end of it. Now, how do you use that information? If you're going to use this as a mechanism to get short, your stop losses can be limited to consequent encroachment and just a little bit above it. Now, what's a little bit above it? It would have to be, in my opinion, at least 3 to 4 handles above consequent encroachment. Because remember, we allow for what? Little mohawks, little coloring outside the lines. So seeing specific PD arrays, and it's not just simply a fair value gap that fails. There's many times I want PD arrays to fail. Think about when I'm teaching you order flow, how every candle supports price. As it's going higher, every down close candle, in that down close candle, algorithmic buying is taking place. So it goes without saying, when it goes above that, and it comes back down and touches it, it's not going to need to go back down in there because the algorithm has already extended the opportunity for the algorithms that use this in a marriage, like a handshaking between the delivery mechanism, the price engines that cause the fluctuations in price, and then the algorithms that can handshake with it. What are we looking for on the opposite spectrum? When we're bullish on price, we want to see down close candles support price because they're acting as what? Bullish order blocks. But we want to see bullish candles on the other side, on the left side, that would be considered what? Bearish order blocks. As price was going lower, every up close candle should have offered what? Downside delivery, sell side delivery, moving lower. So we want to see price going through with ease up through them. That's real institutional order flow. But when we look at PD arrays, if we have met a range extreme, or we traded to buy side liquidity that would constitute a potential reversal, while order flow has been bullish and we've maybe capitalized on that, now if we have seen a run on buy side and then it broke market structure and then rallied up and gave you a 2022 short entry, what do you think you would be expecting as the price is dropping down? Every one of those down close candles that supported price going up, you want to see price eat through that quickly with no hesitation. So every PD array has in its formation a application of wanting to see it fail for the purposes of giving you insight, and then you can use it for a counter trade idea. It has an inverse nature to it. It may not be an inversion fair value gap that you use as your model, but it gives you the flexibility to say, okay, I use fair value gaps to enter, but if I get it wrong, that means it's probably indicating that I'm really offside. So if it comes back up and trades back up into this level here, it might offer some measure of resistance. So therefore we could see an opportunity for it to trade. And where would it trade to? Here's a daily low right there. What could you use as a partial before you get to that? Half of this range, which is what? Right here, which would be right below Friday's low. The opening of that candle and the consequent encroachment of the wick. Do you have to take a partial at every single one of them? No. Which one would make sense for you based on how much you're leveraging, where you got in at, where the entry was? Because it could trade up to here and break extremely hard. And then the only first fair value gap it gives you would be, down in here that you would feel comfortable taking.